A mutual fund is a basket of various securities, whether individual stocks or bonds or maybe a combination of the two, all bundled together. Your first job, if you're picking a mutual fund, is to take a step back and think about what you're trying to achieve. If you're an investor who's just starting out and your main goal is to save for retirement, you probably want to focus mainly on stocks, and so you might look for a good core stock fund. Another fund type worthy of consideration is what's called a target date fund. These are all-in-one funds that start out very aggressive, so they start out holding primarily stocks, but they gradually get more conservative as you get closer to your goal date. One of the other key decisions that fund investors need to think about is whether to invest in what's called an actively managed fund or what's called an index fund. Actively managed funds have an active human being picking securities for the portfolio. So the person may be picking individual stocks or individual bonds or a combination of the two, but it's a person who is actually trying to beat the fund category or beat the fund benchmark. With an index fund, there isn't actually an active human being who's trying to beat a given market benchmark. Instead, an index fund simply tracks a given market benchmark, and the S&P 500 is a common one, in the same proportion in which the securities appear in that index. This is one of the key things to think about as a fund investor, how much you're paying in terms of annual operating expenses for the fund company to put the fund together for you. In all of our research at Morningstar, one of the things that we've found is that low fees are one of the best predictors of good performance. This makes mutual funds different from a lot of other consumer products where you kind of get what you pay for. With mutual funds, you get what you don't pay for. So we urge investors to focus on low-cost funds when putting together their portfolios. One thing that investors often focus on when selecting individual mutual funds is past performance. And it's only natural. It's a show of how well the fund has done for its investors. But as fund companies themselves say, past performance isn't a guarantee of future results. So if you see a fund with very strong returns, do your homework about what steps it has taken to achieve those strong returns. Oftentimes we see a pretty high correlation between high returns and high risk. So the fund that has had very high returns in the past may be taking some big bets to deliver those results. Maybe it's concentrating in individual stocks or an individual sector, and what has paid off for it in the past may not pay off in the future. So as you're evaluating performance, also evaluate the fund's strategy and take a look at its portfolio to make a judgment about how risky it is. Finding a good fund doesn't have to be a lot of work, but it does require that you get your arms around a few key variables. First, what you're trying to achieve. Second, whether you're going to invest in an actively managed fund or one that basically tracks a given market segment. What the fund charges you in annual expenses, and what the fund's strategy is and how it has balanced risk and return in the past. Thanks for watching. I'm Christine Benz.